Welcome, everyone, to the first session of day 2 of the Modern Investor Summit. I'm Stéphane Renevier, an analyst here at Finimize, and I'm joined today by a very special guest to open the second day of our summit and delve into the world of risk management. Stephanie Leung, Chief Investment Officer at StashAway. Hi, Stephanie. How are you doing?
Hi, I'm well. Hi, how are you doing?
Awesome. Very well. Very excited about today. Actually, I think if you enjoyed yesterday, awesome. If you enjoyed yesterday, you won't be disappointed because today looks equally exciting. During our second day of the summit, we'll be running 4 virtual sessions featuring Lisanne Saunders, Chief Investment Strategist at Charles Schwab, Michelle Mayer, US Chief Economist at MasterCard, Karen Ward, Chief Market Strategist at JP Morgan Asset Management, Wayne Thorpe, Head of Research and Analysis Products at AAII, and the one and only Jamie Dimon, Chairman and CEO of JP Morgan Chase, of course. Maybe you can comment in the chat if you're coming along. I hope to see you there in those sessions. But first, why are we all here today? Our generation is facing one of the most complex investment environments in history, high inflation, political unrest, and slowing global growth. And over these next few hours, we want to make sure you live informed and armed with all of the information you need to manage your portfolio as we head into 2024. So this is your chance to hear from informed expert voices to empower you with quality information. Now, to our first session and some very quick housekeeping. If you haven't already, please introduce yourself in the chat box with your name and where you're tuning in from. This will be a 20-minute discussion followed by 10 minutes of audience Q&A. So, don't forget to ask your questions in the Q&A box below. And if you're posting on social or LinkedIn about this event, remember to use the hashtag Modern Investor Summit. Big shout out to our online session sponsor, StashAway. We're giving away 6 months of free investing when you sign up today. We'll drop the link in the chat box, so have a look. Okay, folks, so let's dive in now. So, Stephanie, my first question is, how do you define risk in investing, and why is risk management so important? I mean, as long as your portfolio is going up, why would you need to worry about risk?
Yeah, I think, risk comes in many different forms. And I guess as investors, the most common risk that we deal with is actually market volatility risk. And just to kind of explain why there's such a risk is, well, if you look at kind of asset classes, for example, stocks or bonds, like let's say the S&P or NASDAQ, they tend to go up in the long term, right? Historically, in the last 40 years, US equities return about 10% per annum. World equity return about 8%, and bonds obviously give you coupons as well. So, these are pretty certain over a long time frame. However, in the short term, there could be ups and downs. And these ups and downs are the market risk, right? The market risk that we have to bear as investors. And sometimes the downs can be quite daunting. Like, for example, during the financial crisis, equities actually fell 50%, 50. And during COVID, equities fell about 30% in a matter of just 2 weeks. So as investors, you have to deal with these market downs when it happens, because for sure, it's not a straight line up, and you will face these market drawdowns from time to time.
Thanks, Stephanie. Maybe we can go into a bit more detail. What are the most important types of risks that retail investors face across a typical investment portfolio?
Yeah, so I guess we just mentioned about market risk. Market risk are these kind of ups and downs in markets that you have to experience from time to time. And sometimes the drawdowns are bigger, sometimes the drawdowns are smaller. But because when you invest in public markets, every day or even every second, there is a price that comes up. So whenever your assets are marked to market, you face some sort of potential market risk. Now, there are other different types of risk. And if you think about different asset class that you can invest in, the riskier that particular asset is, the higher the return potential. So the return that you can potentially get from a particular asset class is actually in compensation for the market risk that you take. Now, take an example. So when you invest in US government bonds, these are considered as sort of risk-free assets, meaning that the US government is very, very unlikely or even impossible to default on your debt. So when you look at investing in US government bonds, for example, these are the least risky or sort of risk-free investments. And today, when you invest in short-dated U.S. government bonds, let's say, 0 to 3 month bills, you're getting north of 5.5% in return per annum. And this forms a basis of, what are the additional returns that you get by taking on more risk? So, for example, if you want higher returns than the 5% that US government bonds is giving you right now, you can either go riskier to buy bonds from high quality corporates that issue debt, or even take one step further. If you want even more return, you can actually buy bonds from riskier companies. Now, a lot of us invest in equities, and in fact, equities give you even extra return on top of the risk-free rate and also corporate bonds, because typically the market risk, the volatility of equity is actually higher than the other asset classes that I mentioned, the safer asset classes that I mentioned. So that is one dimension of market risk. Now, there are other types of risk. For example, liquidity risk. This is the risk that you get compensated for when you invest in asset classes that are not that liquid. So, for example, if you invest in private equity, private credit, if you invest in venture capital, for example, these asset classes or these investments tends to have a lockup period of pretty long, right? Maybe 7 years or even 10 years. And as investors, you should demand, or these asset classes should actually return higher because of the extra liquidity risk that they carry. There are other types of risk, for example, counterparty risk. When you trade in a non-public market, for example, if you trade sort of over the counter with another party without an exchange, you're taking on the risk that the other party will deliver what they promised to you. So that's called counterparty risk. And those are the key kinds of risk that as investors you have to consider.
Now, you can't eliminate risk, right? But you can manage it. So Stephanie, what tools or strategies can help manage risks, and how should one use them?
Yes, in fact, definitely risk and returns are kind of, inversely or directly correlated with each other, right? The higher the risk, the better the return that you get. However, there is something called diversification in finance. Diversification means that you put together different asset classes that are not that correlated with each other. So, for example, a very traditional or simple diversification to constructing a portfolio is by putting together different mixtures of bonds and equities. A very common way or a very common portfolio is to put 60% of the asset of the portfolio into equities and 40% of the portfolio into bonds. Why do we construct portfolios this way? Is because during most periods, when there is a growth scares, when, for example, during a recession, bonds and equities are not that correlated with each other. For example, during a recession, or even think back to COVID, equities actually fell quite a bit, but bonds held up or even actually had positive gains. So during difficult periods, that's when the gains in bonds can offset the losses that you have in equities. And so what you've achieved is that because both bonds and equities actually give you long-term returns, in the short term, there may be volatility, but because these two assets or these two asset classes are not correlated with each other, you can actually achieve smaller drawdowns or less volatility by investing in both asset classes. Now, I just cited a very simple example of having bonds and equities. And of course, you can find other asset classes that may not be so correlated as well. A good example would be gold. Gold also performs fairly well when equities are suffering during difficult periods. So that could be a good asset class that you throw into the mix. Within equities, there are different geographical exposures. You can invest in global equities. You can invest in different types of bonds. So, there are different ways to construct a portfolio. I would say that if you go from one asset class or one company to an index, it's already adding quite a bit of diversification benefit to your portfolio. And when you invest in several asset classes, let's say 10 asset classes, that is actually creating a pretty robust portfolio that helps you weather through some of these market downturns. And that is exactly how we construct our portfolios at StashAway, by putting together different asset classes that perform differently during different economic periods.
Awesome. Now, as you said just earlier, if investors want to get a higher potential reward, well, they need to take higher risks, right? So, how should they think, about finding the right balance between, risk and potential return when making investment decisions?
Yeah, I mean, that's a very, very good question, because actually, when most people start to invest, the first thing that they think about is how much return am I going to get? And very rarely people start by asking the question, how much risk can I take? And in fact, as I guess from an investor point of view, from a risk management point of view, we think that actually the first question that you should ask yourself is, what kind of risk should I take? Because as I mentioned before, right, if you invest in asset classes, then your return is actually proportionate to the risk that you take. So once you determine the right level of risk, I mean, the return actually will come. And so the next question is, how do you determine the right level of risk? Here also there is a few methods, and I think there are two dimensions that you should think about when you are trying to determine your risk appetite. The first dimension, or the first criteria, is to think about your time frame. If you think about, let's say, somebody who is close to retirement or has already retired, versus somebody who's just starting out in the career, who's like 20 years old, just have still quite a long career ahead of them, then obviously the retiree can afford to take lower risk than the younger person. Now, it's not just because of age, but the difference actually comes from the period during which you can invest. Because as I mentioned before, right, markets actually go through downturns, and it's very, very hard to know exactly when these downturns will come. And the good thing about having a long time horizon is that you have plenty of time, should a drawdown come, to recover from that drawdown. So, for example, in 2008, I mentioned that equities actually had a 50% drawdown. I mean, that took about a year and a half to recover. So, let's say if you're investing for a mortgage that you need to pay off in 6 months' time, you may not have enough time to recover. However, if you're saving for retirement, let's say for 30 years, then there's plenty of time. So the first dimension that you should think about is, what is the time frame that you're investing for? The longer the time frame, the higher risk you can afford to take. Now, the second dimension is, I mean, really psychological. It comes down to your own risk preference. For some people who are much more risk averse, maybe they think that if my portfolio drawdown is, let's say, 5%, I can't sleep already. I have to watch prices every day, every second. Versus somebody who's much more risk-seeking, who thinks that, oh, I can actually withstand a drawdown of 30% in a kind of worst-case scenario. Obviously, these two investors have very, very different risk appetite, and you have to ask yourself, a very simple way that I use is just ask yourself, what is the maximum drawdown in your portfolio that you can withstand without losing sleep? And that is a good way to gauge your own risk appetite. And if you use these two dimensions, number one, time horizon, and number two, your own risk appetite, then you can think about what is the risk that you can take. At StashAway, for example, we've established something called the StashAway Risk Index, which is actually a drawdown number that we specify for each portfolio. That specifies, in a worst case scenario, what is the maximum drawdown that an investor can experience. And I think that is a very, very good guidance as to what portfolio you should select.
Now, I think, one area of risk that investors probably really underestimate is psychology, right? Like everyone is focusing on what to buy and having a plan, but no one is really focusing on how to respect and implement that plan. And in fact, many people will buy at the top, when FOMO is the highest, and will sell at the absolute worst time when it's at the bottom. And, we fear the end of the world, but this is the bottom. And that's exactly when you actually want to invest. So, what are some practical tips for avoiding these sorts of risk and, for cultivating personal resilience in the face of financial stress or losses?
Yeah, I mean it's not so easy, right? Investing is always a psychological battle. I think that is because if you go with the herd, if you go with the crowd, which is what we human tends to do, it's actually it actually doesn't increase your investment return. So a lot of times we have to go against the grain or go against the crowd at the right time. And there's a lot of different behavioral biases. If you look online, there may be like tens or 20s of them that prevent us from being a good short term investor or a short term trader. However, when we think about investing, if we think about long term investing, the difficulty of psychological barriers actually comes down a lot because there are methods that we can use to overcome these behavioral biases. A very, very good way to overcome these behavioral biases is to establish a regular deposit or regular savings into different asset classes. So, for example, at StashAway, what we encourage our users to do is to set up initially your portfolio according to the risk appetite that you have. And then you can set up a monthly savings plan that it automatically deposits money from your bank into the portfolios. The good thing about this is that number one, you buy more shares when the market goes down, and you buy fewer shares if the market is up. So it actually helps you to sort of buy more at the bottom and buy less at the top. Secondly, once you have these automated savings plans set up, you don't have to watch the market all the time anymore, because the more you watch the market, the more snapshots that you take, the more likely you're going to experience drawdowns. And this is statistically true because over a 10-year time frame, for example, the drawdown periods, the chance of seeing a drawdown is way, way, way lower than if you look at the market on a daily basis, because on a daily basis, things can be quite random. So I would encourage every investor to, set a long-term goal for your portfolio, determine the right risk appetite, and then set up a regular deposit plan. A very good, time, or very good time frame is perhaps monthly, because that coincides with when you get your paycheck. So think about your expenses, think about kind of what you've left every month, and establish this regular savings plan.
Now let's make the last question very practical for our listeners. What are the biggest risks that investors, are likely facing in 2024?
Yeah, I think some of the risks are more macro. So, for example, what the Fed does with interest rates. Are we going to see inflation coming down? Are we going to see a recession in the US? I think all these are risks that we actually monitor very, very closely. Right now, of course, it seems like inflation is coming down and the US economy is still quite strong. But historically, we would note that a kind of soft landing scenario, or just kind of a Goldilocks scenario, has been very rare. Historically, there has only been one case where that actually came true. So history is against a kind of such a case, but it seems like that's what the market is pricing in right now. So I think that's the biggest risk that we have heading into 2024. Now, of course, there are other risks as well. I think the rise of technology, for example, AI, is also potentially a risk to some other small, kind of older industries, or some business models that may get disrupted. And as investors, we have to keep ourselves updated with these new trends all the time.
Thanks a lot, Stephanie. So that's it for the questions to you directly. Now the audience can ask questions, so make sure to use that chat box. So the first question here from Titus: in terms of portfolio diversification, how would you alter the 60-40 split to include other asset classes? Oh, can you hear me? Can you hear me? Can you hear me, Stephanie? Uh, okay, I can take I can take that question in the meantime. So I think there are a couple of ways you can sort of alter the 60/40 portfolio. One is to add some commodities. If you think the environment in which both stocks and bonds struggle is an environment of high inflation, high inflation is bad for both stocks and bonds. That's typically an environment that is good for commodities. So, for example, by adding some commodities to a 60/40 portfolio, you can already kind of make it a bit more robust to, a more inflationary environment. I think gold specifically within commodities is also an asset that would perform well if, for example, you have an economic recession and inflation or interest rates stay a little bit higher for longer. Gold could be a very good addition to that portfolio. And I think adding Bitcoin or crypto could also be a good way of adding further diversification for some more extreme cases. So I think she's back. So Stephanie, can you hear me? Can you hear me, Stephanie?
Yes.
Okay, awesome. So actually, I have another question for you. Which metrics can we use to not over diversify a portfolio?
A case where you put too many different asset classes into a portfolio and without added benefits. So, I mean, there has been some mathematical studies on that. And typically, if you think about asset classes, a number of 13, like up to anything up to 13, would give you additional diversification benefits. But does it make sense to have like 20 or even 50 asset classes? They actually don't improve your risk-adjusted return. So I think that is a good rule of thumb. In terms of if you think about single stocks, if you think about companies, the same could apply as well. But I think for companies, the rise or the invention of ETFs have actually already helped us to diversify quite a lot, right? So buying an ETF is a much better diversification kind of method than just picking a few stocks.
Now, a very practical question next. With a looming recession in the US in 2024, do you have any suggestions for those of us that are retired and focused on income-producing investments? Great question.
Yeah, so I think whether there's going to be a recession in the U.S. is still a kind of open question. Now, of course, U.S. Third quarter GDP was still tracking above 5%. So, I mean, the U.S. labor market is also very strong. If you look at the current consensus forecast and the Fed's forecast, I mean, they're not forecasting a recession. But as we've said, I mean, there's always a risk that the Fed over tightens. And in that case, in a recessionary scenario, actually, that is a very good kind of scenario for long-dated bonds. Because typically in a recession, bonds are safer assets to hold, and they would hold in value or even appreciate in value. So if you are a retiree or close to retirement or just want like very safe assets, then I mean now may be a good time to look at your portfolio. If you don't have bonds, or if you don't have if you have too much equities or for example commodities, then think about adding bonds to your portfolios. Because right now, I mean, if you look at long-dated bonds, let's say, I mean, a 10-year or 30-year bond, I mean, they're yielding north of 4%. So, I mean, that is actually quite good in terms of historically range of different incomes. So, I would encourage you to take a look at that.
Now, another very practical question. How have you learned what you preach? Books, courses, etc. And are there any failures that you learned from that you could tell us about?
Yeah, I mean, that's a great question. And I think I actually learned from a number of different sources. So obviously, I've been managing portfolios live for the last 20 years. And I've learned a lot from my colleagues, my ex-colleagues at Goldman, my colleagues at other asset management companies. And of course, I also read a lot of books. I know, like, for example, Mr. Ray Dalio is a speaker at the Finwise Investor Summit. I actually learned a great deal from him. He produced, he has several volumes of books that documents very much detail some historical cycles. And for those who don't have the patience for books, I mean, he also produces some very, very short, good short animated films that you can easily find on YouTube. And that actually gives you a pretty good understanding into how the economic machine works. Of course, I think as you invest, as you kind of read, like every day, the market teaches you something new, and just learn from some of the best out there, right? Warren Buffett, Charlie Munger, obviously, unfortunately, just passed away. I mean, the two of them are fantastic investors to learn from.
Now, what methods should they use to measure risk and returns? Any particular metric?
Yeah, I mean, typically, if you think about now, returns is fairly simple, I would say. And returns basically is the annual return that you can get, let's say, in a certain time frame. For stocks, I mentioned that historically, in the past 40 years, the returns have been about 10%. And I think for technology stocks are even higher. But I mean, in terms of risk, there are different metrics. I think one of the easiest metrics to think about risk is the drawdown that you experience, that potentially you experience. So, for example, when you categorize different drawdowns, you can think about these drawdowns in different scenarios. So, the worst case scenario is, of course, during crises, during the COVID crisis, during the Great Financial Crisis, how much that asset class was down. And then, secondly, there are some kind of milder recessions. So, for example, during 2011 or during 2015, I mean, typically stocks goes down about 15 to 20% during these kind of milder recessions. And then there is some so-called corrections. And in these corrections, typically equities go down about 10%, like 5 to 10%. And of course, if you think about the bigger crises, they don't happen that often, right? They maybe happen once every decade or so. The 15 to 20% drawdowns are much more common. They happen every 2-3 years. And then the 5 to 10% drawdown happens perhaps every 6 months or so. So when you think about risk, you need to be, I guess you could study kind of history of the asset classes that you're investing in and really understand what are the maximum drawdowns and what are the more regular corrections and the frequency of these things. Now, I think Stefan mentioned about Bitcoin or cryptocurrencies. Typically, I mean, cryptocurrencies are about 3 times as volatile or more volatile than equities. So, I mean, you can expect much bigger drawdowns when there is a crisis, or when even during a normal correction, the drawdown could be bigger.
So, actually, what role could alternative assets play in a balanced portfolio for a retail investor?
Yeah, I mean, there are different types of alternative assets. And I think alternative assets actually play a few key roles. Number one is that it gives you exposure to another asset class that perhaps are not that correlated with public equities or public bonds. So that gives you the diversification benefit. The second benefit is that because these are alternative asset classes, so I mean, for example, in the first case, like unqualified assets, for example, hedge funds. If you invest in a hedge fund, for example, a long-short equity fund, typically they carry much lower beta than the market. So when the market goes down, a hedge fund may not go down. Now, the second benefit is that if you invest in these alternative assets, because they typically have lower liquidity, and as I mentioned in the first, I guess in the beginning of the session, when you invest in less liquid instruments or asset classes, they typically compensate you with higher returns. So some of these alternative investments, for example, private equity investing or VC investing, would give you higher return over the long term because they actually lock your money up longer. So I think there are these benefits for including alternatives in your portfolios, which you should definitely consider.
Stephanie, thank you so much. I'm afraid time's up for that session, but thanks to our fantastic guest Stephanie for sharing those brilliant insights, and all of you for tuning in. I hope you enjoyed it and you can take something away from this session, but don't go anywhere, as coming up next is session 9, From Novice to Pro, How to Screen Stocks Like a Pro, featuring Wayne Thorpe. Head of Research and Analysis Products at AAII. So it starts at 1:45 p.m. In about 15 minutes. So, stay tuned. We still got some merch and surprises throughout the day. So make sure you're attending every session to win something today. So thank you very much again, Stephanie. Thanks everyone for tuning in.